Investors, welcome back to the channel. My name is Ari Gutman, a dividend investor here on YouTube, just delivering through on economic insights as well as brand new dividend stock ideas. And from time to time, I get the pleasure and honor of hosting a guest on the channel, a master of the market. And today we have none other than Mark Rusin, who you may be familiar with as he has a YouTube channel as well, but he is also the founder of Rusin Financial, some one-on-one financial coaching, a dividend investor who's been doing the deal for about 15 years. Mark, my very first question for you is, what exactly is the Mark Rusin story? Can you talk a bit about how you got started in investing and, of course, why dividend investing?
Ari, thanks again for having me. I'm glad we were able to make this happen. A little, backstory on myself. I went to college, went the regular college route, became a CPA. I actually played college basketball. So that was actually the first goal, was to, go on, and every basketball player's dream is to go play the NBA. But unfortunately, that doesn't happen for too many people. Didn't happen for me. So, I went the accounting route. It's very, very similar. But, I was a CPA at a big four accounting firm here in Orange County, California, which is where I still live to this day. And worked there for about 6.5 years. And that's really where, it opened my eyes into investing and really seeing how many of these companies, many of these management teams, very different management teams run very different businesses. I was able to audit some of the largest corporations here in the U.S., and that really allowed me to understand balance sheets, P&L statements, as well as cash flow statements, and started my investing journey. So I've been investing for about 15 years. I've always, I have a very diversified portfolio. I don't just invest in dividend stocks, but primarily the majority of my investments are in dividend paying stocks or ETFs, index funds, anything like that. Just like the idea of building passive income. I can go to sleep at night knowing that my money's still working for me, whether a stock goes up or a stock goes down. I'm still building that passive income. So, just continuing to put money to work and really, using that Warren Buffett type mentality to invest in companies with strong free cash flows, invest in companies that are returning money to shareholders, because there's a lot of folks out there that want to say, well, that money's not going back into the business. Well, that's not necessarily a great thing in many cases. In some cases, there is management teams that reinvest money wisely, but there's also a lot of companies that don't. So I would rather, that money in my pocket, and that continues to compound over time. And that's just, that's been my lure to dividend investing.
It's a great intro there for yourself. And I'd like to say, I think playing college basketball, for me, it was wanting to play college football. I grew up myself in Princeton, New Jersey. Was not planning at all to go pro ever, but enjoyed the game. It was in college that I actually began to get very interested in investing. And I actually started investing myself about 8 years ago. Now, initially, I started off really building a portfolio with what I like to call a foundation of an ETF. But
Sure.
I'm curious to know, because also you just being a CPA, I feel like naturally, accountants are a little bit more safer, if you will.
Yeah, sure.
You may be on the opposing side there, but I'll ask you, when you first started investing, how safe were you? Were you more riskier? Did you jump into more growth stocks at first? Like, what has been really the secret to success for you over the last 15 years? How did you start? And maybe how did you see yourself changing as an investor over this time period?
So I think so the first stock that I ever bought was Caterpillar. So whether that you call that safe or not, jumping in at the first stock you ever buy into an individual company, it being Caterpillar, somewhat safe. It is a cyclical company, but if I did it over again, I don't own that company anymore. But it was, early on in investing, if you lose like 8%, you're like, oh my gosh, this is rigged. I'm out of here. So I think that was one of my key things, and, been investing for 15 years. But the key was that I started small, whether it was $50 a month early on, just, building that up. And, it's really been within the last decades when I have been really adding true, real money is what I call it, thousands of dollars on a monthly basis to the stock market. So, it doesn't matter where you are in your journey. It's just getting started. So if I did it again, I would definitely go with a S&P 500 index fund or ETF. And, that's what a lot of the clients I work with in my investing coaching course, it's a 6-week course, is trying to build a strong foundation. Because if you go through these, the market turbulence, which is just, the normal cycles that the stock market goes through, you want something to fall back on, and something that's an ETF, a S&P 500 ETF, or, something like a SCHD, which is a dividend paying ETF. That's something I want to have as a strong foundation, the backbone of my portfolio. So I quickly sold that once I, continued to educate myself and learn more. And really, now if you look at my portfolio today, you'll see a Vanguard S&P 500 index fund is the top position in my portfolio.
Can we get a peek into the portfolio a little bit more? Which fund are you heavily invested in? Which one is your foundation?
So the S&P 500 VFIAX is the top one. So that'll be the top index fund. And then I have a Vanguard Dividend Appreciation, which is VDADX. So those are kind of my two, it gives me broad exposure to the market. So, I'm gonna take part when the technology companies are doing well, and when those slow down, and industrials are doing well right now. I'm still taking part in that. I'm not just heavily focused in one area or the other.
Sure. Likewise, on my end, I'm heavily invested in VTI, Vanguard's Total Stock Market Index Fund. That's actually the very first fund that I started with. It's been the fund that I've been running with. I've actually been thinking more and more about investing into an SCHD myself, just to get a dividend fund in there. I've been reluctant to do it because I've actually been, trying to build this dividend investment portfolio. And I don't want to have a portfolio of, say, 20, 30, 50 stocks. I really wanted to hone in on maybe like 10 to 12 very solid dividend paying stocks on top of that VTI or, SCHD fund. The question, though, I have for you now is, you actually alluded a little bit to it, right? The market could be quite volatile at times, which is, like right now, right? Just having about, 10 to 20 stock positions within my portfolio, I certainly feel that volatility. And it's not just for me about having, just one or two funds. What would you say in terms of like macros mattering? Do you think they matter? Or do you think it's just about investing into, that ideal fund and solid stocks and just the long-term investment strategy, and, macroeconomics don't really matter? Or how do you factor in the macroeconomic, climate that's out there?
Sure. Great question. And, for me, my mantra is always, I prefer time in the market over trying to time the market. Not to say that I don't try and time the market, because if you look at my, I have a newsletter that goes out each and every week. There's a premium subscription to it where folks can see my entire dividend portfolio. I do a monthly write-up of that. And if you were looking at that today, you would see my cash position is actually a top 5 position. I've been building that up. It's number one. I've been adding my regular monthly cash to it, which builds that up, and just trying to find a spot for it. And right now the macros is playing a key role on why I'm not totally jumping in. Technology has had this huge run. Industrials, materials have actually had a decent run in catching up, but it's been a lot of this one-sided move in the S&P 500 with the top, what do they call them? The Magnificent Seven. Now we got a new name, it was FANG, and now we're in Magnificent Seven. So anytime we get a new name for these big tech stocks, that's when I get worried. But it's really been one-sided. If you look at I think it's RSP is the equal weighted S&P 500, there's a big disconnect. And when you go back over the past decade, 2 decades, you'll see that those two tend to trade, within a few percentage points, not all that, not a huge gap, but it's been a sizable gap of late. And just seeing, there's tensions between, large countries, whether it's, Russia invading Ukraine, it's the China-US relationships now. And then it's just, just here in the US alone, still dealing with inflation that's really stagnant, and the Fed saying, no, we don't have one more hike. We have 2 more hikes at least. We're not talking about rate cuts for another, 2 years. And that's, been a position that I've been on, saying, hey, we're not going to have rate cuts for a while. And, people are kind of cheering rate cuts, like, the market goes up when they hear that sometimes, but rate cuts usually coincide with a poor economic activity that's going on. So that's not something to cheer all that much for me. So, the macros definitely play a role, but I'm going to continue to add and look, SCHD dipping under $70 the past couple weeks. I dabbled a little bit there and just looking for, there's still plenty of value plays out there. I'm just not jumping into them all that aggressively. It's really nibbling at them and just taking, when they're that low, even with the macros, I say, hey, I got to take a flyer. I'm comfortable with the valuation this particular stock ETF's at right now. Let's add a little bit to it here and there.
Sure. I almost feel like, from video to video, whether it's on my channel or, even just sitting with customers. I work at Tip Ranks, right? So even sitting with a lot of our customers and what I like to call our customer experience sessions, it's been interesting because when I talk to people about investing and I use that phrase or macros matter, I think a lot of people tend to get the idea that I'm saying time the market and that we can successfully time the market. I think it's important, though, to note what you shared, which is like, macros do matter to an extent, not necessarily to time the market, but having an understanding about, perhaps when to be cash heavy or, in another angle there, timing the market in the sense of recognizing which sectors are good sectors to look into at a specific time or which stocks to look into at a specific time, because the market is cyclical. And in the longer term, right, it's not that I'm constantly timing the market looking to buy, Apple exactly at its lowest low. It's more so watching for the ebbs and the flows. And just in the longer term, being a dividend investor and deploying that macros matter strategy for myself, it's actually been quite successful. And I also like that you shared earlier on that you like to sleep at night, which is why I'm assuming you enjoy dividend investing. And I want to reel us back into some dividend stock talk, if you will.
Sure.
And ask, what does your portfolio look like in terms of the growth stocks that you do have and the dividend stocks you have? Because you also shared that I think you do have growth stocks within your portfolio, and you're not all dividend stocks.
Sure. Yeah. So, trying to be diversified, especially, with my kids. So they each have their own, Roth IRAs. They help out with my business. They do, some of their own work and they're young age. It's just a way to, get a couple $1,000 a year for them to start. So, I definitely invest in growth stocks for them. They have a much, I feel like I have a long time horizon, I hope, fingers crossed. And, they have a much longer one. So it's really trying to develop a strategy to get them excited about investing. And, for my daughter, she loves Disneyland. We're only about 30 minutes from Disneyland, so she's got Disney stock. Not all that great of a performance, but it's trying to get her excited about that. So that's one for her. But and then my son likes John Deere tractors and he likes jets. So I have him invested in Raytheon, which or Lockheed Martin, which that's a dividend stock, but in Costco he loves going to Costco with me. Again, another dividend stock, but more of growthy, has a less than 1%. For me, if you're looking at my portfolio, I have the Googles of the world, Amazon, you could even call Apple with it, they have 0.5% dividend. It's a dividend stock, but I'm invested in it for growth. I've had some CrowdStrike in the past. So I usually I do options. So I try to generate a couple $1,000 per month through, selling either covered calls, cash secured puts, credit spreads, and all that much. So I'll do that with CrowdStrike a lot of the time, like that business a lot and what they're doing there. But my largest holding is Google in terms of a non-dividend paying stock.
Wow, actually right on the money. Mine is as well. It's one of two non-paying dividend stocks in my portfolio. It's Tesla and Google. For me, I bought Google on the dip not too long ago, and it's shot right up. So I have actually been debating whether or not to sell out of it or just hold it because, as a dividend investor and being a little bit more risk adverse, I'd like to take the profits and put it into some of my dividend paying stocks. What do you think about that?
So Google, I've held on to, but they've it's definitely been a roller coaster. So, you getting on the dip was great timing. I've held Google, I want to say, for probably 6 years now. It was one of the first stocks when my sister wanted to start investing, that was the first one we bought on the, she bought it before that when we had the huge dip back in, I want to say it was like 2015 or something.
Right.
I was out on vacation and Google's stock dropped like 15%. And I remember she's like, hey, the day before she had put money into her account, finally got it all opened. And I looked at my phone, and I usually check the market one of the first things to see how the futures are doing. And all of a sudden I saw Google was crashing. I ran to the table, logged on real fast, and bought her Google, and she's up, she's like 3 or 4 extra money since then. So she got in it way ahead of me, but we've just she's a long-term investor too, and just kind of riding with the ebbs and flows. But I understand the idea. You and myself being dividend investors, taking gains and pouring back into a passive income strategy is definitely intriguing.
I've been back and forth with it. Like on one
Yep.
end, it's Google, but on the other end, like the dividend investor side of my heart is like, sell, buy more dividend stocks. I mean,
Right.
I've profited so much with it. I'm like, wow, I really, I could just use this on some nice dividend paychecks to come.
Right.
Again, it's Google. So it's do I sell? Do I not? I haven't yet decided. I think I might hold, and I'm sure you've seen even just over the past 6 years quite a bit of growth with Google.
Absolutely. Right.
Now,
Yep, that is a key one, with how dominant they are with just, cloud and search, and starting to put in AI. They may not be up to to par with the Microsofts and with their open AI investment, but Google is something that, they just have such a dominant position in search. And you gotta love YouTube, right?
oh yeah. Now on the other hand, I had when I bought Google, I did the day that I bought it, I was actually typically, at work at Tip Ranks, I will give, economic insights to the team, the writers to write the articles, et cetera, et cetera. Now, when Google is falling, that's all I could talk about that day. And I was watching Google stock, I was buying Google stock, I was telling people to buy it, buy it, buy it. And I considered making actually a YouTube video on Google, and I didn't because I feel like my channel is so dividend investor centric
Right.
that I can't make that type of content. It would throw a
Yep.
lot of people off. But it is one of those stocks that I bought that I say, you know what? Because it's such, in my opinion, a safe stock, and it's very likely to be around for the long term, I'll
Right.
put it in my portfolio. I'll hold it. I want to go back into actually, you mentioned with your son and with your daughter, which I love, by the way, that you already have them investing, and especially into dividend stocks. Touche, my friend. That is that is great. My uncle, who I always talk about, and almost every conversation when it comes to investing, really got me involved in investing when I was young. And he had, going to his house, he had always shared, investing is pretty easy, right? You have to find the companies that you're most interested in, because when you're most interested in those companies and with their products, what they do, you're going to research them, you're going to follow them, and you're not just investing into numbers, you're actually taking part as being a stakeholder in the company. And I love that you already have your kids doing that. Now, on the other end, I hear a lot of the time that, even at someone in their 20s, I mean, I heard this in 2020. I was with someone, he's maybe in his late 20s. And I said, man, you got to invest. Like, you got to invest now. It is the great year. And he goes, I don't have enough time. I know you do a lot of one-on-one coaching, and I'm sure there's a lot of talk and investing out there. But what's your take on someone in their late 20s, their 30s, their 40s? Do we get started in investing even though the time is ticking for us?
Yeah, so I always say, if it's a older person I'm working with, it's never too late to start, but it's also never too early to start either. So in the 6-week investing accelerator course I go through, we're really focused on building out a strategy and a blueprint, and it's for investors of all different levels. So I've had investors come to me that say, hey, I don't even have a brokerage account yet, Mark. They go through the course. We get the brokerage set up, and then we develop a plan. What's your strategy? Or how are you risk averse? Or do you want to take more risk? What's your time horizon? What is your interest? What's your goals and strategy? And just build that out completely, and then start diving into more complex situations. How do you know when to invest in a stock, or looking at the differences between ETFs, index funds, and mutual funds? Because there's a lot of similarities, but there's also a lot of differences as well. So we go through that, and it's a completely customizable course. But back to the question is, I don't ever think it's too early. I think it's really early on. You know, we don't. At least I didn't have a ton of money. I didn't come from a family that had, you know, my background wasn't. We weren't sitting around the dinner table talking about dividend stocks and investing. It was, you know, it was more spending money, like, you know, the average person out there does. It was really just developing that habit for myself and educating myself through books and courses and stuff like that, and just, you know, building the habit of throwing $50 a week or a month, and then, you know, knowing hopefully my income is rising year over year, so the next year maybe it can be 75 or 100, and then 250, 500, just continue to compound, because knowing with dividend stocks, you're going to get paid a dividend. It's not going to be all that much early on, and you got to know that going in. Far too many people, when it comes to dividend investing, and a lot of the trolls of the world that are out there, the thing with dividend investing is you can't look at the year one dividend income. You got to look at the year 10 plus dividend income and where your yield on cost is going to be. This is one reason why today, if you buy shares of Coca-Cola, you're going to get a 3% dividend on the money that you invest. If you look at Warren Buffett, he's earning over a 50% yield on cost just by, you know, continuing. It's the same stock that you're investing in today, but he's been investing in it for decades, and just taking that money that he gets paid in dividends and reinvesting that to that's just simply the power of compounding. So, you know, just understanding that process at an early age. You know, I wish I was investing more in my early 20s, and, you know, although I've been, like I said, investing for 15 years, the bulk of that, you know, has been in the last, you know, 8 or so years is when I've been what I call, you know, investing real money to make that difference. So, you know, it's building the process, building the habit, and getting that money working for you long term.
I got to put you in the hot seat with this one. How, like, ballpark range, what right now is your brokerage account sitting at?
Well, I had it pulled up right here. So I'm approaching it's not even working right there. About $225,000
There
right
we
now.
go. Investors, Roosin Financial, you got to get with them for 6 weeks.
That's right. Yeah. And it started small. It was like $50, $100 a month. And then, you know, just as my income went up, you know, I don't need to spend more on certain things. I didn't go out and buy myself a nice car or anything like that. You know, I drive 2 paid off vehicles right now, and trying to just push as much as I can early on, because if we don't use it towards something to make money, we'll, you know, naturally human nature will spend it on something that, you know, is depreciating in value or doesn't make money.
The unfortunate reality. I remember just becoming a dividend investor and looking at my, you know, passive income that was coming. I was so excited for the passive income checks to come in, right? But then I saw all these YouTubers doing the deal, and I'm like, I can't wait for mine. And I invested. I remember like the first month, I think I pulled in like $4 and something change. And I was like, is this really worth it? But you know, time takes time. And that's, I think you hit the nail on the head there, because these days, I mean, I'm over about $100 passive income a month, but it's nice to see every single month the passive income flowing in, and just letting time do its thing, having time in the market and letting those passive income checks flow in, you know, and getting yourself invested into high quality companies to really just hold on to. And on that topic, so I really, when it comes to stocks for myself, you know, I typically look for companies that have fantastic management teams. I look for companies that have very strong brand names that can really prevail through the twists and turns and ups and downs of the market. And of course, last but not least, the final piece of criteria for me is really looking at a company's balance sheet and scrutinizing it and making sure, of course, that they're not in debt. But those are the pieces of criteria that I typically run with. And I want to know, you know, for investors who are out there, perhaps just getting started, and you're looking at your passive income flowing in and saying, is this dividend investing, you know, strategy even worth it? Well, can you give us a little tidbit of the criteria that you look for? Because you also mentioned, right, the yield on cost, and Warren Buffett, you know, making boatloads more because he's invested in Coca-Cola for X amount of years, probably longer than all of us. But what are some tips that you can give us? You know, and I know we can't pack 6 weeks into about, you know, 15, 20 minutes, but perhaps just 30 seconds, you know, a minute on some strategies for all of us.
Yeah, I think especially if you're just getting started, the key is to, understand. If you don't understand the company, it's probably not a good idea. And I think you kind of hit that, right there is you're investing in a company. You're think about it like if you were to go buy a rental house, you're going to invest in that rental house. Well, you're not just buying a stock, you're buying the company. So understand what they sell, what the demand is for those type of things. But for me, I think management is key. That was one of the reasons, back when I started my social media journey, 3-4 years ago, AT&T was the big stock that everyone wanted just because it was a high yield. But what I say is never invest in a stock based on yield alone. It's far too many questions I get them on a daily basis. Oh, this stock's great. It's got a 14% dividend yield. Well, what else is going on? Well, I don't know. It just has a 14% dividend yield. There's usually a reason, and if you understand stock price and dividend yield has an inverse relationship. So if a stock price tanks, a dividend yield is naturally going to go up. It's going to stay there for a while, but probably the next quarter or two, if there's truly underlying issues at the company, cash flow issues, that dividend's likely to get cut. That's something we saw a lot during the global pandemic. And that's why I focus on companies that have strong fundamentals, companies that have proven that, through these economic flows that they can still generate strong amounts of free cash flow, whether the economy's booming or whether the economy's in a recession. There's certain things out there that people still need, so for me, the cash flow statement's a huge one for me. If they have large amounts of debt or, really any debt, I want to know that number one, are they able to fund their debt, continue to pay down debt, and continue to fund a dividend? And I know no one thinks this because it's a dividend stock. They actually reinvest into the money from the cash flow statement. I know everyone, that's always the message I get is, oh, that could be another, $2 million that can go back into the company. Well, look at AT&T. How did they do reinvesting their money? They went and bought DirecTV. Well, I would have rather that money been paid out in a dividend stock. You see that all the time with growth stocks making huge acquisitions for big money that just don't pan out. So, everyone's saying, well, that money can be reinvested in. Well, that's not always the case. It's not always a successful strategy. So I like these management teams that make sound reinvestments in terms of acquisitions that, if they work out, their capital allocation strategy is on cue. You're looking for A-rated balance sheets, so strong cash positions, lower debt amounts, and just going back to the free cash flow, because that's where everything happens. Once you get to free cash flow, which is just your net operating cash flow, and take out your capital expenditures, that is what's used to pay dividends. If there's not enough to cover dividends and debt right there, it's probably a red flag, because they're probably using debt to pay a dividend. So that's a major red flag for me. And then just looking at valuation, and I even do use technicals. The valuation part helps me understand when to get into a company, or the companies that I like in terms of valuation, quality, and all those factors that play a role. And then the technicals kind of help me time, when is the ideal time to kind of jump into a stock. And then, if I'm jumping brand new into a company, I do utilize I utilize a cash secured put strategy. So selling options is a way I get into new positions from time to time.
There's so much, I mean, really to unpack there that we can dive into. But something that, particularly was interesting, to me is yield chasing. And you touched upon it very beautifully. And a lot of videos, I will get comments, from time to time with people saying a 3% dividend yield,
Right.
a 4% dividend yield. I'm looking for 12. I'm looking for at least 7%. And it's something that I even struggle with, to be honest with you, commenting, back and saying it's not always about chasing yields. I mean,
Right.
It's about chasing strong companies that can prevail over the long period of time. At the end of the day, like we both shared, we want to sleep at night. We want to know that our money is working for us, invested into quality companies that are going to be around in the next decade, that are going to be around and continue to pay us to allow that dividend snowball to roll. So I'm sure you've experienced a lot of similar comments. And I know just from watching your channel myself, which, by the way, if you have not already checked out Mark's channel, it will be posted there in a pinned comment, and of course, in the description as well. So head over there. He's got a lot of amazing stock ideas I, for one, am always heading over to Mark's channel as well, so you'll probably see me commenting. But I wanted to know, Mark, when it comes to dividend stock ideas, I mean, right now we are looking at a pretty interesting 2023. We've had, of course, elevated interest rates for a prolonged period of time. We've had inflation that's been sky high. It's been coming down, but it's still, double what the Fed is looking to get it to at 2%. So right now it's at 4% inflation. And as you already mentioned earlier in the call, Powell just came out and really sounded the alarm bells here in sharing that we're going to get most likely 2 more interest rate hikes. And that's going to, of course, raise our terminal rate. And I think that's ultimately going to pressurize businesses and consumers. It's going to create a very, I think, uncertain, volatile environment. Not to predict the future, but to the best of what I can see in the future, that's what I'm foreseeing. I want to ask you, just based on where we are at right now in this current economic climate, what are 2 to 3 stocks that you have in mind or that you're perhaps looking to invest into for the remainder of 2023 that you're really focused on, that you're really trying to grow, or that you really think have potential, over the long period of time?
So that's an interesting question. I think you hit a lot on there. Is the uncertainty in the near term here with the Fed comments and just the pressure that's going to be added to the economy. You have interest rates are going to put a ton of pressure, especially on growth stocks that rely more on debt to generate growth. That's where it comes back to the free cash flow. And these companies that are a dividend stock tends to be more of a mature company that's been around. And when things get tough, I look at healthcare, which has been a underperforming sector. And if you look at my portfolio, my top 10 positions, I do have a lot of healthcare. Johnson & Johnson is one of my largest holdings in my entire portfolio, a top 5 holding. They've been doing much better of late, but for a while they were lagging the market pretty badly. But that's a sector that I continue to look to, because regardless, I know they spun off their consumer health segment recently, but they still own 90% of it. So in a way, that's still part of Johnson & Johnson. But it goes back to when the economy goes down and families are struggling or layoffs increase, whether you have a headache, you're sick, you still need Tylenol. It doesn't matter what the economy is outside. If you have allergy issues, you're still going to Zyrtec. If you got to wash your hair, you're still buying Johnson & Johnson products. If you skin your knee, you still need a Band-Aid, regardless of what the economic GDP is for that quarter. So that has me always moving back to healthcare and that safety. And I understand when things are booming, you're going to underperform. And the key isn't to, always be outperforming every single quarter. It's that long-term horizon to know if I'm someone that doesn't want to, ride the roller coaster up and down, for the NVIDIA shareholders that, that was up to $300-$400 and dropped down to 150. I mean, imagine the people that bought at the top and sold at the bottom. I know everyone has ridden the wave perfectly, by looking at social media, because that's the only stock that matters these days. But it's just trying to build that safety net and understand and look for the sectors. I'm a value. I like to search for value. When tech's doing great, I'm still looking at tech. There's some great. I recently did a video on 4 AI related dividend stocks, and looking at Cisco and IBM. I don't own both, but definitely looking more at Cisco. I've owned them in the past, and seeing how they're starting to turn things around a little bit more is another value tech play I'm looking at. Qualcomm they haven't participated in this AI craze at all lately. Broadcom, is one I own and love. That one's skied, up 60% or so in the past year to date. So, there's some companies, even in the technology sector, that haven't participated in this AI craze. REITs have been under pressure, and just looking for high quality REITs there. I know that I invest roughly 20% of my portfolio into that real estate sector. That's my way of getting rental property. So just looking for those high value ones. Prologis, Realty Income, which is trading at a yield of 5%. That's always a marker for me, is to buy Realty Income around that 5% threshold. That's typically a great valuation area for me. If you look back over the last decade plus, you could see anytime they've touched that 5%, it's been a great entry point for them. So that's kind of a few names that I'm kind of looking at here and just taking my time with.
Love to hear it. Love to hear it. I'll have to have you back on the channel, especially at the end of the year. We could see if our predictions here and the stock picks that we're talking about now were actually ripe at this point in time and great investments. I think they are. Johnson & Johnson is actually one of my largest investments as well in Realty Income. Now, investors, like I said, Mark has his very own YouTube channel. I highly, highly recommend heading over to Mark's YouTube channel. Give his videos a watch, get some of those stock ideas from Mark. Moreover, head over to Ruzin Financial as well. There is that 6-week course that you can jump into with Mark himself and actually learn how to become your very own master of the market, if you will. Mark, I want to thank you for joining me for at least a brief stock talk here on my channel, and I certainly hope to have you back on the channel again and soon. And happy investing to all those out there. Good luck investing this week. And until next time.